And now we have newer to the public markets is ROK Resources. With us today is Bryden Wright, COO, and Jared Lukomski.
Close enough.
Close enough. Who's Senior VP Land and Business Development. ROK trades under the symbol ROK on the Toronto Venture Exchange and also on the OTC under PTRDF, which is always a mouthful, those OTC symbols. I'm not sure which of you is going to share the screen.
Share the screen, and Bryden can kind of start to walk us through a recent investor deck that we just put on our website.
Yeah, you guys just had a budget update since your last webinar you had with us about 3 weeks ago. So if anyone wants a fuller story, they can have a glance at that one.
Yeah, absolutely. All right. Well, thanks, Jess. Thanks for including us in this conference. We're a little bit of the new kid on the block, so we want to share our story, share our team, and provide some updates to everybody that's listening. So we come from a private energy background. Us three founders, Cam Taylor, our CEO, myself, and Jared. We built and sold 4 companies in Southeast Saskatchewan for over about a 12-year period. The last of which to Torque in 2018. And so we decided in, I guess, late 19, early 20 to go the public route. And that, brings us to where we are today. So the 3 of us have worked together for, like I said, about 15 years. Cam was the previous CEO of 3 of the 4 companies and continues in that role as chairman and CEO. And then myself, chief operating officer, and Jared, our senior VP land and BD. So I'll speak quickly on our past transactional history. We built and sold 4 companies in Southeast Saskatchewan, all of which were basically built from the ground up, 0 barrels a day. So built, land acquisitions and by the drill bit for the most part, with a few, key acquisitions here and there. We were able to transact successfully on all 4 of those to Crescent Point, Legacy, and Torque for the last company. And like I said, we then moved into the public space for a number of reasons. Primarily at the time, it was, lack of access to capital, lack of liquidity for shareholders. And, our shareholder base was a pretty tight knit group for the most part. And they were looking for, other options. And that's what brought us to where we are.
If I may, Brad, I'd also add, another reason why we made a decision to go public is there wasn't a lot of consolidation in the space, anywhere from 100 BOEs a day to upwards of 3,000 barrels a day. And we thought we could play a small role in that, providing liquidity to some of the private oil and gas companies where shareholders were feeling a bit of fatigue. And it kind of fit well into our material acquisition that Bryden will talk about.
So we began acquiring land and assets just on a very small basis back in 2019, just the 3 of us. And, we were always looking for a high quality set of assets, ideally in Saskatchewan or Alberta. We've been based and out of Regina for our entire careers, I guess, Jared and mine, the last 15 years. And we wanted to focus on Saskatchewan, but also look elsewhere. And so, what we ended up transacting on, which Jared, you could go to the next slide, was this federated co-op asset base, which we knew very well. We had been partnered on a number of locations in the past with some other companies in the basin, and something that we had coveted for a long time and had a lot of experience with. And so we originally did our first small acquisition back in 2020, the day that oil went negative, and added some smaller pieces over the next year until in March of 2022 we transacted on the federated co-op asset base. And so it was a $72 million deal that we financed with a combination of debt, $65 million facility, as well as an oversubscribed bought deal through Echelon of just over $17 million. The asset base is a combination of Saskatchewan light oil, solution gas, and then Alberta. The Kaybob asset is about a 50-50 gas to liquid actually probably 70-30, I guess, gas to liquid ratio, but we do see a lot of upside, which I'll speak to here in the coming slides. So again, prior to the deal, we were growing. We were 200 barrels a day. We were tiny, and we were looking for that transformational acquisition. It came in the form of the FCL assets, where we white mapped them out of all of their upstream production. And what this asset has done to ROK is transform us into a high cash flow company that can pay down our debt in an expedited fashion, and the mechanism, or the debt structure, allows us to do so with no prepayment penalty. So we just did release some guidance. We're looking to drill 10 operated wells in Southeast Saskatchewan this year and exit at 3,500 barrels a day. We're sitting just under 3,000 barrels a day today. And this asset base, because of where we locked in our hedges on the 8th of March, as well as the quality of the oil and gas plays that we have, we're able to generate a significant amount of cash flow, upwards of $67 million annualized for the remainder of 22. And it generates free cash flow even with our aggressive debt repayment structure. The asset itself, again, the base production and really impressive net operating income that it can drive, really high net back oil, low royalty rate. We're in that around that 13.5% royalty rate across the board corporately. The hedges we did lock in as a covenant of our debt, 75% of our declining PDP over a 24-month period. And, it was a very lucky timing. In all honesty, we were able to hedge on the day that oil hit $128 and put ourselves in a really good position over the next 24 months. We have a, significant land base, just under 1.4 million gross acres of land, significant amount of upside, both in Kaybob, as well as Southeast Saskatchewan in terms of drillables. And then, of course, our interest in the Weyburn unit, which, everybody on this call likely is very familiar with that unit. And, both it's just rock solid production and low decline, but also its ESG, impact on a company like us. So as far as our current capitalization, we have just under 188 million shares outstanding. With the raise, we did, issue a fair number of warrants. That being said, we believe, as that capital, as those warrants are exercised in, 3 years from now, and we bring in the cash, we think that there's significant torque and upside, even with that dilution as we bring in that cash. On the forecast, again, 3,500 barrel a day exit rate, we're forecasting that's driven by an $18 million CapEx program, the bulk of which is the 10 well program, as well as some workovers both in Alberta and Saskatchewan. And so, one of the things that we really liked about this asset base was, it was a little bit capitally starved over the last 4 years, and a lot of low hanging fruit, especially with this commodity price increase, both on the gas and liquids and oil side. And so we have a modest $1.5 million budget on workovers, or rather reactivations and optimizations. And that may be increased as we, move forward in the year. But we do believe that there's a lot of upside, both from a drilling standpoint, but also just reactivation, a little bit of infrastructure work in Alberta, and all of that will drive that cash flow over the course of this year, given the strength of our hedges. So this slide, again, because of the the hedge book that we were able to secure, the price of our unhedged volumes doesn't have a material impact on 2022. Obviously, as we add more production and the wedge of production that is hedged declines, that may change, right? But as far as you can see the sensitivities here at $60 oil upwards to strip as of last week, it's only about a $9 or $10 million difference on our NOI. And, as well on our free cash flow, we would range from 6 to 15 million of free cash flow. And that's assuming 37.5% amortization on our first year with our debt, as well as additional cash sweeps that we've built into that. So, our goal over the next 2 years is to retire this debt, which does not have a prepayment penalty. And so we can, our focus is number one are to reduce our debt. We we are forecasting roughly a 40% debt reduction by January of 23, and then look to retire that debt within a 2-year period. At that point, we envision we'll be in excess of 4,000 barrels a day and cash flowing anywhere from $60 to $80 million a year, and being in a really good position as far as our balance sheet goes. So this slide is a bit of a peer comparison, and as you know, we're small. We're a lot smaller than a lot of our peers, even some of them on the calls today. But I think what we try and highlight to investors and to the market is that our goal is to grow. Our goal is to both grow through the drill bit and through acquisition. And I think there's a lot of torque based on where we're trading today. I think we have the ability with this asset base to achieve a significant amount of cash flow and free cash flow, and that's our goal. Our goal is to retire the debt, increase our free cash flow per share, and begin to pay a yield, incorporate a dividend at some point, and as soon as possible, and begin to pay our shareholders. And we have a strong track record of growing companies by the drill bit, and I think it's going to be a combination of that with really strategic tuck-ins on the acquisition side, and understanding that the M&A market's a little bit more challenging over the past 3 months, 4 months than it was when we did this deal. But I do think that as long as we're prudent with our analysis and our what we're looking to acquire, I think there's an ability to grow with the right assets in addition to what we have today. So our focus of our Southeast Saskatchewan drill program for 2022 will be in the Frobisher formation for the most part. I'm thinking I think 9 or 10 of the locations are all in the Frobisher, and I guess anybody that's operated in Southeast knows the economics that can exist in this formation and why it's such a valuable and sought after play. It's it's complex geologically. There's risk, but we do believe that we have a number of lower risk locations that we do plan on drilling in the next 2 weeks. We'll probably be kicking off here 3 weeks. So the economics, as are phenomenal in some of these plays, and we've built this based on our GLJ curve, or rather McDaniel curve, that has been booked on. I'd say 90% of our locations are booked on this curve. There is a tier 1 curve a little bit higher that we don't use in our forecasting as well. But we're excited to get out and drill and show what this asset base has to offer. There's a subset of the land that we owned in previous ROK, where we are drilling 3 of the 10 wells on, and then the remaining 7 are on the Federated Co-op land base. So in Kaybob, this is a big growth area that ROK will undertake in late 22, early 23. We have, it's a stacked reservoir with about 8 or 9 zones of interest. And we have rights in all of them, at least on, the bulk of our land base here. And, what I'm showing you here is the Cardium, in which we have about, I think there's 12 book locations. And, we see upside, of another 10 to 15 potential locations here as well. And, the economics on the Cardium start to get really interesting, at that $80 mark for us. And, I think there's some ability to really, I think, grow a reserve base out here. I believe it's, fairly conservatively booked. And there's a lot of players that are starting to get, active in both the Cardium, but also in the Montney now with gas prices, the Dunvegan, the Blue Sky, and we have rights in a lot of these formations on a variety of areas. And so, we're going to kick off a workover program in this area this summer, and a reactivation program. And then our drill program will start in early 23. And so we're just working through that today, but it's a, phenomenally exciting area. And, the Montney is a completely unbooked zone for us in our reserve report. So we believe that there's a lot of ability to grow reserves on the gas side. And again, we're going to look to deploy capital here in 2023. So we did an update on our reserves as of April 1, and we did that with McDaniel. It's when we did the deal, it was $72 million acquisition. PDP was about $96 million. That's now increased to $114 million. The one thing about our reserve report, I historically Federated wasn't very aggressive on bookings, and I believe that we kept that consistent. And our goal is to grow this reserve base over the course of this year and exit, with some attractive increases. And so I do think that there's a lot of room for growth, both from a reserve standpoint, but also from a drilling location basis as well. So, as far as catalysts for growth, one of the bigger things that we've been working on as a management team is getting our name out there and our faces and our story, understanding that we're at the early stage of ROK and our growth is just beginning. So in April, we released the updated reserves report. Recently, we announced our budget for 2022. We will kick off our program, which again is a 10-well program plus about a 10 or 12 well workover reactivations in Saskatchewan, plus an additional 3 to 4 wells in Alberta. And then the actual drill program up in Kaybob in 23. And so, why do we believe that we're, a company that can grow this, the reserve base and actually provide return to shareholders? I think, again, it's our track record and our ability to build and sell companies, but also just the ability to grow companies from, a stable base into something a lot larger. And this asset base has provided us that platform to grow from. And again, we have 3 to 4 potential bolt-ons that we are in various stages of evaluating. We're aggressively going to pay down the debt and improve our balance sheet. And we're excited to get moving and continue to engage with the market.
Well, thanks for that. That was a very good update and fast. So just a few questions for you guys. With your workover program, you're spending $1.5 million on, how much production do you think you can add?
So we're adding roughly about 1 million a day of gas is our expectation, plus an additional 150 barrels a day or so of oil. So, what does that take us to? Give or take 300 barrels a day. That's our goal to bring on. And that's a combination of Alberta, Kaybob area, as well as some Southeast Saskatchewan workovers.
Like you said, there hasn't been capital really deployed on these assets since 2016, since they've been for sale. So you must see there's more low-hanging fruit than what you're saying as far as that amount of workovers. Yeah,
so we're in the early stages. Like I would say specifically in Alberta, that's right, Jess. It's there is I'm in Calgary right now, meeting with the team and just working through a number of these locations that have just been, capitally starved, and there hasn't been any capital deployed. And obviously, part of that is gas prices over the the last 8 years. So, yeah, to answer your question, that's not the maximum that we have to do work on, or as far as workovers and reactivations go. There's probably another 20 locations that we're doing a lot of work on here. So I think that's just the beginning of that program. And again, because of the amount of zones that we can target that look really attractive at both oil and gas prices right now, I think you'll see a lot more work from us and hopefully some positive news over the next 12 months.
Perfect. Thank you. So after this program that you're starting in June, first of all, are any of these locations ones that could be considered, new pool or pool extension opportunities?
Yeah, one in particular, we're drilling a bit of I wouldn't say exploratory well, but it's a new pool potential discovery in Saskatchewan. And so, it's a vertical that could end up, upon success, resulting in an additional 10 to 15, locations. And, if that's something that is completely unbooked, something that would provide significant, cash flow at this price. It's a Frobisher play. And as you saw in the slides, the economics are really, really solid at this price. And so, that's an area that we're extremely excited about. And one of our first wells we're going to drill. And then there's a couple others, probably 2 other locations that have been, again, just, very conservatively booked that we could, let's say there's one location booked in one of our one of our core areas, and we believe there's upwards of 7 or 8 drillables there. So yeah, it's we're drilling some lower risk step outs, but at the same time, there's room for reserve growth on a number of these locations, and that's part of our strategy.
So while you're paying down debt, you're improving NAV by adding to your reserves production and paying down debt aggressively. So that is a good combo. With your debt repayment, how much, like you say, you're aggressively trying to pay that down within 2 years. Zero debt's obviously not an efficient use of capital either. What would be your ideal ratio?
Yeah, I think we want to target about 0.5 debt to cash flow ratio. I think you're right. I don't think having no debt on the balance sheet is an effective way to run the company. And so if we were to, eliminate that debt, or, I think a real option that we'll consider is a recap of that debt and bring in some more conventional debt. And of course, with that is our ability to grow and look at other acquisitions and kind of consolidate that into a one transactional item. But yeah, I agree. It's, we'll always probably carry a little bit of debt on the balance sheet, but our 0.5 or less is kind of our comfort zone.
Okay. And is there any opportunity to it's somewhat expensive debt given the inability to get RBLs from banks if you're under a certain size. As you grow a little bit here, do you think there's a chance to bring, to either term that out or find an alternative source?
There is. And, we're having those conversations today. We've met with a few groups about that option. And I think, to your point, conventional debt under 10,000 barrels a day is a real challenge. That may change over the next year. Maybe banks will be a little bit more aggressively, looking at these opportunities, because I do think, given where you can lock in hedges, there's a lot of there's a lot of opportunity rather for financial institutions to create some relationships with companies like us. But yeah, we are going to aggressively look at that, the refinance option. And it may come, like I said, with other transactions, or, when we get to early 23 and, we're sitting with, say, sub 30 million in debt, we may have that option to do that at that point.
And you mentioned you're looking at numerous acquisitions at this time. Like they wouldn't be huge, I would suspect, but there's probably a lot of private or mom and pops or PEs, private companies that would be looking to transact. Would they be willing to take your stock?
Yeah, there are certain parties that are, absolutely. And those are the ones that we've been having conversations with. I think given our ability to grow and kind of where our stock is trading today, I believe that there's a fairly big interest from these groups to take paper of ROK. And we're open to that at the right price, and assuming that the metrics are accretive to ROK. And it's about growing the free cash flow per share. And that's really what we're focused on. So I think we'll look at a combination of debt and equity in the right scenario. But it is tougher. And I believe the previous presenter said, the same thing about acquiring in this price world, in this, $100 plus. It's a bit more challenging. And I think the buyers are looking to buy at $80 or a deck that's a little bit lower, and sellers want, 105, 110. So
yeah, then the price keeps changing. So then every day as well. So yeah. It becomes very difficult to get a deal done.
Exactly.
Yeah. So on the back of that, you guys have grown your other companies right from like buying the land, running seismic to drilling. So right from inception, now you're starting with a good base of production. Do you feel comfortable growing this to a larger size? And with your current staff, how big do you think you could get comfortably without having to add a bunch of people?
Yeah, we do. And I think looking back at our previous companies in the private space, we never had a mandate to grow to 2,000 barrels a day and sell. It was always let's build a company, get it into a position that makes sense, see what the market looks like from an M&A standpoint. And it always just seemed to be that, 2 to 3 year time frame where we'd always be in between, 2,000 and 3,000 barrels a day.
And someone would want you. And
yeah, exactly.
Yeah.
The opportunity was there. And that's what the market was doing. There was always those mid-cap companies that were looking to gobble up, these small privates. But as far as the goal of our management team and the plan for this company, it is to get larger. We'd like to be, 5,000 to 10,000 barrels a day, 2 years out from now. I think there's a reality with this asset base to, if gas prices remain strong, to grow this to 5,000 barrels a day as it sits today. And then, through acquisition, try and add a couple thousand barrels a day. So as far as the comfort level and the ability of our staff, we have a very strong staff in Calgary that we were able to acquire from FCL. And in addition to our core staff in Regina and Southeast, obviously from a field perspective, we'd be adding bodies and adding the right people if we did acquisitions. But I think from a internal team and management group, I believe we're capable and very interested in running a larger company.
Okay, awesome. And if there was one key takeaway, being you're new to the public markets, what should investors be focused on, and where do you think your forte is?
Yeah, good question. I think, our forte for sure is, growing by the drill bit, operationally strong. I think we know how to position companies to sell. But that being said, I think we want to provide full transparency to shareholders and let them know that our plan is to grow, provide at some point, provide a dividend, start paying them back. And really it's we're a hungry team, we're a young team for the most part, and we're a team that hopefully is going to be around a long time. And, that's really the one thing I want the market to know is that we are kind of in the earlier stage of the public space, and we're really enjoying it, and our plan is to grow and be around for a while. So
I want to take a second and brag about the technical team a bit, which includes Bryden. But everything we did in the private space, our technical team went from 0 to 2,000 barrels a day, and having access to 1.4 million gross acres of land. I think we're really excited about where we can take this prospect and the potential of other opportunities as well. So, I think that our company's strengths is on the technical side without question. And this asset, again, provides that framework for us to be able to grow. So I think that's where our excitement is today.
And you guys are very old. So it's, you have to do something for another 30 years, I would hope.
We have lots of kids then, so
20 years, yes. 20.
And there are not many new teams out there. So it's great to see. And so congratulations on your acquisition. And we look forward to hearing more from your success from your drilling program.
Thank you, Jeff.
Thanks a lot for having us.
Okay. Talk soon.